Good afternoon, everybody. Uneducated Economist here. Be sure and hit that like button when you come into the live stream. By hitting that like button, the YouTube algorithm will pick up the video, spread it around for more people to join in. And the video is a heck of a lot more fun when we have more people commenting and joining in on the discussion. Today we're going to be talking a little bit about the credible threats of lowering interest rates going into the future and how that can boost the markets. Now, this is something very interesting taking place within the bond market. Take a look at the article I leave down in the description. And there is a lot of junk bond sales taking place right now. Corporations are raising cash. And now this is a very interesting time to think about raising cash, because if you imagine higher interest rates and trying to take out loans with higher interest rates, as you go into the future, servicing that debt with higher interest rates is very burdensome. Obviously, you want to get the best interest rates you can. And so when you're taking out loans when you have a low interest rate, this is the time that you would really want to raise cash. However, we're seeing corporations right now really jumping into the game of selling a lot of bonds, right? Junk bonds. These are low grade bonds into the market right now ahead of the Federal Reserve and the idea of lowering rates. So if you were to lower rates in the future, well, then that would make it a better position to sell bonds, right? Because you would get a better interest rate if you were to wait for a lower rate to come into the future. But yet they're selling their bonds off today to try and raise cash, when yet there's interest rates coming in the future. It doesn't really make a lot of sense to me. Like, I would postpone, or at least try to postpone as much as we could as far as taking out that debt in order to achieve a better interest rate. But yet we're not seeing that happen right now. So what's happening, right? The demand for the bond itself coming from the market has elevated. They are seeing a good price bond, and if interest rates fall into the future, that means the bond prices go up. So if the market is looking at interest rates coming into the future, well, they want to get into that low grade debt, because that's going to be very cheap when you have high interest rates. If they can get into that debt and the rates come down, the yields come down, and the bond prices go up, they're speculating that they will be able to sell those bonds into the future for a higher price. And so with the anticipation of the Fed cutting rates, the market itself is now very prevalent within the bond market in order to acquire those bonds to sell it off in the future if those rates were to come down. Now, I look at what the corporations are doing as opposed to what the market is doing. And the corporation taking out debt at an elevated interest rates doesn't make sense unless the Fed doesn't cut. See, if the Fed doesn't cut and the interest rates stay elevated, or even more so, continue to rise, or because of the belief that rates are coming down has pushed the yields down some, going into the future, if the Fed decides not to cut, the yields may rise. The bond market or the corporations would have been able to get just a slightly better rate by selling the bonds today. And then in the future, if the Federal Reserve doesn't raise, or does raise rates, or doesn't cut, I guess I should say, the interest rates, or the market's belief inside of the interest rates, should elevate. And this is the perfect position for those corporations to have acquired some cash. See, this is very difficult to wrap your head around, all things that are taking place, because everybody just looks at the Federal Reserve saying they need to cut. Right? They look at it and say, "Oh, the time has come. They've achieved their goals. Now it's time to cut." And I'm thinking, does everybody in the market see this backwards from me? Because way I see it, if the Federal Reserve is cutting, that means you're in bad economic times. It means the economy is slowing down dramatically. It means you have recessionary pressures that have been pushing so dramatically into the economy that they have no other choice but to try and stimulate by lowering interest rates. Now, I see that could be a possibility, but I don't see that being the case today. Yes, we have slowed down dramatically in the economy. I know it. I'm facing it. I do retail sales for a living, and things have slowed down incredibly over the last few months, and definitely over the last year. So when you think about what the economy is doing as far as slowing down, yeah, it's taken place. But unemployment is not at a level that people would be, hey, this is recessionary pressure, pain, the experience of depression, that kind of thing. No, that's not happening with unemployment. I mean, it's rising. It's somewhat elevated comparatively to what we had, but is it the painful experiences that we've had in the past with unemployment? Not even close. And the inflation that we are experiencing is starting to come back down into a more reasonable expectation. Yes, it's still elevated. Yeah, there's a lot of things out there that people can point at to say, hey, this hasn't come down and that hasn't come down. Well, a lot of stuff isn't going to come down. It's not going to come down like lumber came back to a normal price, but you're finding that the increasing in prices have slowed down dramatically, and we're not seeing those dramatic increases like we once had. That's inflation. Deflation is when prices actually come down. We're probably not going to experience that in a dramatic fashion. The Federal Reserve is going to do everything in their power to prevent deflation from occurring. It is their biggest number one scare. You don't believe me? Go back and look at Ben Bernanke's speech from November of 2002 titled Deflation and How to Prevent It from Ever Occurring. He was scared, and that was back way before he was even a chairman of the Federal Reserve. So it's deflation is the biggest concern coming from the Fed, not inflation. Inflation is what they were needing in order to save their monetary policy. And they're totally getting it back right now. You can see the market's perception in hopes and dreams and wishes and praise that the Fed is going to be lowering interest rates. The corporations use that. They use that perception. They understand the credible threats. When the communication comes that they are going to be lowering interest rates into the future and the people believe it to the level that they do, I mean, you think about it, how like better than 90% of the market out there, or it's better than a 90% anticipation of September rate cuts. This is what surveys are anticipating. 90% of the people say that there's going to be a September rate cut. That's almost 100% belief. Now, that starts to impact the economy in a realistic fashion. People start behaving in a way that those rate cuts have already happened. They're trying to position themselves ahead of the Federal Reserve. And by doing that, the rates actually come down. They start to find better mortgage rates. You start to find better bond yields. You start to find all the interest rates that are out there start to move in the fashion as if the rates had already been cut, even though it hadn't taken place. The corporations know it. They know about these credible threats, and they take advantage of the situation when it comes. I mean, you think about it right now, if the Fed doesn't cut, and they say, oh man, we're still going to be data dependent, come September, and we're going to have to wait until the next meeting, then you know that the people are going to end up reversing everything that they had anticipated going up to September. They're going to be like, oh man, they're not going to cut, and then everything will come undone again. And then the closer we get to December, again, they will rally up the credible threat. And it very well could be that they do cut. However, once they do cut, it's over. They cannot reverse it. They cannot go the other way. The markets will lose their mind. Right now, they have the markets in an open-ended belief. Like they do not know what the Federal Reserve is going to do. And that is the magical power that the Federal Reserve uses. They push that information in a very deliberate communication in order to get the markets to believe that direction. If they do, the markets do believe it, it will perform a task within the economy as if the Fed had already cut rates. That is their monetary policy. It's important to recognize it and to know that if they do mess it up by eliminating the open-ended belief that the Fed could or may or may not cut rates, by eliminating that open-ended belief and they secure it with a definite rate cut, it will be a grave mistake if it was too early. Grave mistake. They have said this over and over again. Now, if they wait too long to cut, it will be a painful experience, but they do not describe it as a grave mistake. They just talk about it being a painful experience. So waiting too long, err on that side, is most likely where the Federal Reserve is going to position themselves, because cutting too early would be a grave mistake. meaning that they would not be able to readjust their monetary policy to go the other way. Right now, the communications work incredibly well. Now, with that being said, there is some disconnect that is beginning to take place over the last couple of months. And we're going to do more reporting on this as the time goes on, because it very well appears that the interest rates are not necessarily following the Fed's expectations. And this is a disconnect that has just started to take place over the last 2 months, right? Essentially, since the people believe that there is going to be cutting rates. The expectation has fallen, but the interest rates didn't necessarily fall in the dramatic fashion of which the expectations had moved. And again, this is going to be information we'll talk a little bit more about as it starts to develop. Because up until just recently, expectations and interest rates would stay in lockstep with each other. So we may find where the Federal Reserve has no other choice, because the interest rates are not following expectations, that they do have to cut in order to bring the rates down in the fashion that is most appropriate for their monetary policy. But it's going to take time to see that actually occur, and we won't know it until they actually make that move. I believe that they are going to do their best, their absolute best, to keep their monetary policy and the expectations open-ended, so that they can use their communications within the interviews that they do, the articles that you read, everything that's out there. If they could keep it open-ended, then they can keep the movement of the stimulus or restriction available just through the communications. And I think that's more important to them than the actual cutting of rates, which would then lock them in. They wouldn't have any, they would lose a lot of the ability to communicate the credible threat or the job owning or forward guidance, however you want to look at it. They would lose a lot of that ability. Very important to know this stuff. Like, nobody will discuss it in this fashion. Like, everybody is really locked into the mechanical, classical version of the Federal Reserve and how they operate. Right? They look at it and say, okay, well, there's a 2% target. If they're above 2%, they will try and bring it down to 2%. If they're under 2%, they were going to try and bring it up to 2%. Inflation is at 2%. And this is where a lot of people are misunderstanding the Federal Reserve and how it is that they are conducting themselves, because they no longer go for this 2% target. And once you have eliminated that part of it out of your mind as far as what it is that the Federal Reserve is attempting to achieve, it makes everything else a lot clearer to understand. Because if you try to take this information and then relate it into they're going for a 2% target, it makes it very obscure and very difficult to understand. You think, okay, they made a mistake. Oh, they don't know what they're doing. They waited too long, or they're waiting too long, or they whatever. It's just like all this stuff that you've been hearing about the Federal Reserve and how they screw it up over the last couple of years really has worked incredibly well for their monetary policy, especially the belief that they had screwed up and is causing inflation to run, rampant or hyperinflation. That expectation that the people had about the Federal Reserve and how they lost control and how inflation was going to ruin the economy was the exact belief that the Federal Reserve needed in order to get the interest rates to be elevated to save their monetary policy. It's one of the strangest things for a lot of people to try and understand or wrap their head around, is that the inflation expectation that was running rampant through the economy was what saved the Federal Reserve. So a lot of people said that they were going to be on their way out, the dollar was destroyed, hyperinflation coming, BRICS nations are going to take over. There was all this stuff out there, and all that communication that people had, all this scary expectations and stuff, literally raised the inflation expectation, which got the Federal Reserve to then raise the Fed funds rate in order to beat the inflationary pressures that were happening. And that move right there got the Federal Reserve's ammo back. They were out. They were out of the game. They had hit the lower bound of zero. They were no longer able to stimulate the economy. And that was back in the great financial crisis. There was talks about, after hitting the lower bound, without quantitative easing, without the QE 1, 2, 3, and 4, the Federal Reserve would have had to take negative interest rates to 6.5% on the Fed funds level. 6.5%, in order to acquire the stimulating effects that the quantitative easing had on the markets. The quantitative easing was essentially a mind trick on the people, right? A balance sheet expansion of $850 billion to $4.5 trillion filled up the big bank's balance sheet. All these people saw all this money. They took on an idea that there was going to be a hyperinflation. I know, I was one of them. Right? I dumped every dime I had into silver, believing that the dollar was going to be completely destroyed and silver was going to be the only thing that was going to have any kind of value to it. That was the belief I had way back in 2009, 10, going into 2011. And that whole expectation of all this money printing and all the things that were going to come from it had the same effect as a 6.5% negative interest rate. This is what the Federal Reserve is doing. They cannot go into negative rates. They know it. They know the adjustment of monetary policy through interest rates is not going to stimulate the economy. But all the belief, the narrative, the push, the hyperinflation, money printer go burr, everybody's going to lose their wealth, lose their purchasing power, lose everything in their mind, right? Or everything in their life, including their mind. That right there is what the Federal Reserve needed. And now I'm not trying to say, hey, this is a great thing. I'm not saying that, right? I'm an observer of the situation that is happening out here. And as I saw that the Federal Reserve was sitting in a position in which that they had an inflation expectation that was persistently too low rather than too high, and that's their words, not mine, right? That was their own words, that they have solved the problem. The problem of an inflation expectation that was too low rather than too high has been solved. They have an inflation expectation that is too high. Perfect. Problem solved. That's what they were looking to do. And it's obvious now. I hope at some point that as the Federal Reserve changes their monetary policy, because they are going to go into another review of how they conduct themselves here at the end of this year. See, they did it again. They did it back in 2020, but nobody recognized it. How they changed their monetary policy from a 2% target to flexible average inflation targeting over time, which means that appropriate monetary policy may have interest rates or a Fed funds rate or an inflation rate, I guess I should say, well above 2% in order to make up for times when it didn't achieve the 2%. Average inflation rate over time, not a target. And so understanding that this is the monetary policy, this average inflation rate over time, and not a target, now that the Federal Reserve has come almost to the end of the timeline in which that this monetary policy was going to exist, they are about ready to review it, and they very well could change. Again, from flexible average inflation targeting right back to a 2% target. Or maybe instead of backward-looking inflation targeting, they go to forward-looking inflation targeting. These are all different forms of monetary policy. Nobody knows about it. I mean, like, the only reason why I know about it is because I read so much about it from the Federal Reserve trying to research flexible average inflation targeting. Since nobody out there on the mainstream media has any clue that it exists, the only place you can find this information is through the Federal Reserve itself. And so, as adamant as I've been out here trying to push this information about how the Federal Reserve is not going for a 2% target, but going for the average inflation rate over time, and that you have to internalize this information so that you recognize some of these articles that you are reading and why it is that these corporations are conducting themselves the way they are. These guys are taking advantage of this situation. They saw the credible threat that the Federal Reserve pushed out there. 90% of the people believe that there's going to be lower interest rates going into the future. These corporations can sell bonds right now. If the interest rates do not go down into the future, you may find where the market perception then shifts, those yields start to rise, and those corporations were able to gorge on cheaper debt today than they will be in the future. They're taking advantage of the credible threat. But they recognize it. Most people in the markets don't. And it's because they don't, the corporations are able to do this. I mean, like I don't know how many people are getting it, right? Because I don't know if I'm explaining myself, correctly for somebody who's just first time ever watching this kind of video or watching one of my videos. The people who have been following me for some time, they recognize it. They recognize that these corporations are gorging on this cash right now, or the ability to get the cash right now. Right? considering that if the rates don't go down into the future, if the Fed doesn't cut, the market is going to shift perceptions, those yields will rise, and they will have had acquired cash at a cheaper price today than they will in the future. Right. It's hard. It's hard to recognize the credible threats. Once you see them, once you know it, once you know this is the plan in the game, it's a lot easier to understand. It's a lot easier to recognize it and to be able to pinpoint it out when you see these articles. Most people will not have any idea. They, like what I just theorized as far as what's going on with these corporations, it is such a far off foreign concept for them. They would never be able to even, conceptualize it. But once you understand it, once you get it, once you have that credible threat theory in mind of what it is that the Federal Reserve is attempting to do, it makes so much more sense. Alrighty, guys, I've just been babbling on here. Let's go ahead and read through some of these comments. All right, Isaac, let's go. We got A person. Hi, Brody. Hey, Simon. Hey, everyone. 2 more Fed meetings before rate cut. Hit the like on the way into the stream, please, everybody, because that will make YouTube share it more widely so we get more interesting questions in here. Lunchtime, absolutely. Why lower rates when you can lower bait? Yep. $35 trillion debt for U.S. now. Good morning, everybody. Hit the like button, please. Hey, Dishes, thank you for being here. All right. The VIX is high. Print more money. Nice to get a little summer rain. Yeah, it is, actually. It's pretty nice. A lot of people pay in cash now, retail. Some merchants don't take cash. Yeah, that's right. I would agree with you, Rusty. Counterfeits. Deflation hurts the government, but it helps the real economy. I don't know if it necessarily helps the real economy. I think it helps the saver. I think it helps the producer, like not necessarily the producer, but definitely the saver, right? Because if you have a deflationary scenario, right, here's the problem that you end up having is that most people don't want to see their wages go down. Right? That ends up staying fixed. And so it's very difficult to maintain wages when you have the products that you're selling depleting or falling in price. Let's say I sell TVs. Right? If I have a TV for sale for $100, right, and all of a sudden deflation is now running rampant. Now I paid, let's say I paid $80 for it. I mark it up, put a margin on it. It goes up to $100. So I'm trying to sell it for $100. But deflation is running rampant through the economy, and now these products aren't selling. So the only way to get the products to sell is to lower the price. Well, now if I take it down to 90, I'm only going to get $10 for this TV, or maybe even worse if I have to take it even less than that. But the person I'm paying to sell the TV, their wages didn't go down. So now, instead of earning $20 off of this TV, I only got 10. This person is getting paid the same. Profit's all gone. So now the business has to shut down. And I'm sorry, you don't have a job anymore, so now you're laid off. But, you can buy cheaper stuff, but you don't have a job. So, is that a good economy? Doesn't sound like it. It depends. Good economy, bad economy, who knows? That's how you position yourself. It would be a great economy for somebody who is saved up their entire lives waiting for the moment to buy a cheaper TV. Hey, they're in it, man. These businesses are closing down. They're loading up on assets these personal assets like crazy. Whether it's doesn't matter what it is. Yeah. And so that position, yeah, you're doing great. But if you are in a position in which that you're living paycheck to paycheck and you're trying to figure out how it is that you're going to earn some more money, and all these businesses are shutting down, and competition for employment is incredibly fierce. You're going up against, hundreds of other people who are going for that same job. Deflation is not fun. That's not a fun position to be in, right? Right? So deflation is not a good economy. Inflation's not a good economy. It's just the way the economy happens to be operating at the time and how you've positioned yourself for it. Very important to understand. If you were somebody who owns businesses and you're employing 50 people through 10 different businesses, and all of a sudden your food carts or your laundry service or whatever, your mortgage broking company or whatever, you have slowdowns in transactions. These people don't want to take a cut in pay, so you have to lay them off. And that's what ends up happening in a slower, in a deflating economy, is that literally people are going out of business and, there's horrible times. Now, yeah, the products got cheaper, so that's awesome, for the people who have money, but that's usually only the rich. And so the rich separate themselves from the poor even more. And again, good or bad, whatever, it's just the position you're in. There is no inflation. The Fed should be printing money and go to negative territory, some politician. I know which politician said that. Let's see. Uh-oh, there we go. All right, all-nighter up in the house. It's great to see you, man. All-nighter hung out with me this weekend. It was our birthdays, and so we hung out and had family came over on Saturday, and we did like kind of barbecue, Thanksgiving kind of thing going on, Thanksgiving in July. And then checked out the Maritime Museum, and then all-nighter took off Sunday morning. We ran him up to SeaTac. So it was a cool visit. I was really surprised to see him, and that was a lot of fun. So it's great to see you back in the chat again. Da, 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 da. When are you going to start opening packages from the P.O. box? Oh, yeah, I've gotten a few in, and I have to thank, Matthew actually sent a package for Freddie. It was really cool. Freddie was stoked about it. He had sent him some baseball cards, so Freddie was really excited to see that. And then somebody, I guess, sent me an Amazon gift card, but I don't know who it came from, so I guess that was for my birthday. Thank you very much, whoever did that. But I haven't been seeing much mail over the last few months, and really over the last year or so. I mean, there was a time there that I could do a mail call once a week. There was plenty of mail, and it was a great video that I would do, but I really don't get that much mail in anymore. So send me postcards. So chart this, the easy chart, from 100, 200, 500 years. It just keeps getting easier. Now remember, easy and better are not the same. Things will continue to become easier. Let's see here. They better separate from me. All right, we're all on Easy Street. It feels so sweet because the world is but a treat when you are on Easy Street. Yeah, isn't that so? Isn't that the truth? Yeah. All right. Will the Federal Reserve intentionally prop up the dollar because more foreign exchange is to buy Treasury bonds? Will the Federal Reserve intentionally prop up the dollar because more foreign exchange to buy Treasury bonds? When you say prop up the dollar, would that mean try to bring a stronger dollar, to bring more purchasing power to the dollar? Or to prop up the dollar meaning try to create a situation in which that the dollar is more accessible and used? Which one of those is propping up the dollar? Because I think those are two different directions. If you were to try and create a situation in which that the dollar would have more purchasing power, then that would be the exact opposite of what it is that you would need to do to try and provide liquidity to the world so that they would use the dollar. Those are two different directions. And I believe that the Federal Reserve is sitting in a position in which that they have to provide the world with their liabilities, those dollars, the Federal Reserve notes. Now, they don't have to provide the world with it, but if they don't provide the world with this dollar, then you're going to see some serious consequences from that, and mainly depressionary effects. And you think about it, the world runs on the dollar. As much as we hear stories about the BRICS nations and people dumping treasuries and all this other garbage out there, okay, that's true stuff. I'm not trying to say that it isn't factual things, but the meaning that is being given behind it is not accurate in my opinion. Now, a lot of times when you see nations dumping treasuries, you'll hear the story of saying they don't like treasuries, they don't want treasuries, they're trying to say screw the dollar, they're trying to say screw the United States. That is not the case. Now, it very well could be some of the feelings and maybe a little bit of the intention that these foreign holders of treasuries are attempting to do, like get out of the dollar, get out of the treasuries. But that's not what they're doing. Most of them are selling treasuries because they want the cash. They need the cash. Cash is what you need in order to pay off your debts. So when you have a debt issuance across the globe that is done in dollars, like it's not anything to do with the Fed, doesn't have anything to do with the government, like the U.S. government, doesn't have anything to do with U.S. banks, no corporation, none of that stuff, right? But debt is being issued in dollars. Well, that debt that is being issued in dollars creates a demand for dollars in order to pay that debt off. The Federal Reserve is in a position in which that if those debts are running like they need to be paid off and they're starting to come due, their demand for liquidity starts to rise. Well, then that starts to strengthen the dollar. The Federal Reserve then needs to provide the world with the liquidity in order to pay those debts off. If those debts don't get paid off because there's not enough liquidity out there and the dollar is strengthening, then you will find that depressionary effects begin to come from the defaults and, bankruptcies and everything that happens because of that. Right? It's not like they are required to make sure that there's enough money so that these guys can pay their debts. No, it's not like that at all. What they are looking at is like, man, there's a huge demand for our liabilities, and that sends a ripple effect around the entire globe. And the reason why there's such a demand for their liabilities is because of the third parties that are out there away from the United States that have issued out debts in dollars, creating the demand. So now the Federal Reserve has to deal with this issue that it didn't come from their creation. It came from other people creating it outside of the United States. A lot of people want to look at the Federal Reserve and then cast blame. And I was just like, are they to blame for other people's issuance of debt that is done in dollars? I mean, they can't stop these people from doing it. Can you stop me and you from doing a contract that's due in dollars? Of course not. Right? If we establish this contract, that's a contract that's due in dollars. That's a demand for dollars. That contract can be used like dollars. So not only do you have the dollars that are needed to pay off the contract, but then the contract itself can act like dollars. Now, how many transactions are being done in dollars when you have contracts that are completely made up by people who have nothing to do with the United States and then using those contracts as if it's money, right? Like as if it's like currency, right? Very big difference between money and currency. But that's what's going on out there in the world. So what is the Federal Reserve trying to do? Are they trying to prop up the dollar, or are they trying to provide the world with the liquidity to meet the demands of the entire globe who have issued out debts in dollars? It's a very difficult position to be in. While providing the world with this liability, the dollars itself, how do you do that without destroying the United States, forcing them into ever-increasing amounts of debt issuance, U.S. treasuries, going deeper into debt? I mean, if you don't have the treasuries to buy, how do you provide the world with the liquidity? You can't, right? So the government goes deeper into debt. The Federal Reserve acquires those treasuries for an asset to put on their balance sheet, and then they issue out the dollars. Well, if the government doesn't go into debt, then what is it that the Federal Reserve is going to buy? Oh, I'm sorry, Bitcoin? Was that it? Did I hear Bitcoin on the menu? Okay, we'll see how well that works out for them. Because even in that sense, you are limiting the amount of Bitcoin that can be available for purchase. Again, right? How is it that the Federal Reserve is going to provide the world with the liabilities, with those Federal Reserve notes, with the cash? Right? Very difficult. And it's not just easy, oh, they can just do it. Oh, okay, well, if that's your belief that they could just do it, then turn the channel off, man. You don't need me anymore. Because I'm figuring out how it is that they can do that, because I know they just can't do it. I know that they're going to have to get into the purchasing of foreign debt. They're going to have to purchase SDRs. They're going to have to purchase gold. They're going to have to purchase mortgage-backed securities. And apparently, they may be the ones purchasing Bitcoin. I doubt it, but it could happen. Right? But it won't be enough. And it won't be enough to provide the world with the cash. Right? And then even still on top of that, you're going to have the safe and liquid asset being some contract out, somebody else's contract that's written by some corporation or some government out there that has, that you're going to trust? Are you going to trust that? Even though it's written in dollars? Are you going to trust a Chinese bond that's due in dollars? Are you going to trust like a Turkish bond that is due in dollars? A Brazilian bond that's due in dollars? Are you going to trust those? Or are you going to trust the United States Treasury? I mean, most people are like, oh, those other ones, yeah, maybe, kind of. I'll trust them a little bit. U.S. Treasury, guaranteed. Yeah, no doubt about it. Good as cash. Good as cash. No doubt. So it's a very different, good question. Seems like it could be soon to me. What is he asking? Let me just go up in Little Zip. What do you ask? Little Zip, when do you think we could become a 100% cashless society? When the Federal Reserve goes to go into negative interest rates, that's when we're going to have to be 100% cashless. And it'll take some time to do it. But ultimately, it's going to come to a situation in which that the banks are going to charge you. And you'll see it happening. Because what they're going to do is they're going to charge you to withdraw and deposit cash at the bank. And that fee that they're going to charge you for deposit and withdrawals will be equivalent to the negative interest rate that is attached to your bank account. So it will not serve you any benefit to withdraw all your money in cash. In fact, it will be more of a burden to you because of the lack of transactions that you will be able to do with your cash without having to pay, again, like a fee. So here you have all this cash. The banks are charging you a fee to withdraw or deposit it. You go to the store to buy some milk. And they're saying, hey, are you going to use your crypto wallet or your digital wallet? And you say, no, I'm going to use cash. They say, fine. Instead of, $5, it's going to be $5.50. And why is it more? Because, we're charging you a fee because the banks charge us a fee to deposit the cash. So this is going to become very burdensome. People are going to be like, well, I'm not going to spend my cash if I'm going to get charged a fee for it. In fact, I won't use cash at all. I'll just have whatever little working capital I have in the bank, and everything else will be moved into other assets, because why would you keep your money in a negative bearing account? So that's what will end up happening, is that you will see the need or the desire by the central banks to move into a negative territory. And by moving into the negative territory, cash will have to be removed from the system. So that's really what I would be looking for. Do not fall for the idea that the digital currencies is there to benefit you. They will sell it to you as a benefit. We're going to help bank the unbanked, provide, funding to the people for like like food benefits, food stamp kind of things. There's going to be less fraud. They're going to have all these things out there, but ultimately it's to lock you in to the system so that they could go negative interest rates and remove cash out of the system. Now, it's going to happen. So there's nothing you can do to prevent it, but don't fall for the idea that it's for your benefit. All right? That's not going to be the case. It's going to be sold to us that way, but it's not. That's not the truth of the matter. The truth of it is that they're about ready to just take cash out of the system and go into negative rates. That's why they want to have the digital, period. Like all the rest of the stuff, the taxing and tracing and doing all that draconious, tyrannical stuff. Yeah, that's all part of it. And I have very little doubt in my mind that it will, eventually be, one of the screws that they put to the people. But in all realities of the situation, what they are looking to do is to remove cash and go negative. That's the reason. Otherwise, it wouldn't matter. Yeah. All right, what time is it? Oh gosh, guys, it's getting close. All right. Yep, hit the like button. We got 144 people watching with 78 likes. All right. Oh, wow, we all have birthdays, huh, Tahan? Right on. All right, seems like a real hurry to get to negative rates. I don't think so. Every person on the stream has the capability to fight it. Don't go along with the cashless society. Yeah, stay curious. I don't know if you're going to really have much choice in the matter. I mean, what are you going to do? Like, we can do everything we can try to prevent it from taking place. But since most people don't know or won't realize why it's happening, and even no matter how much we try to communicate the reality of the situation, it doesn't, like, I mean, I have 140, about ready to cross 143,000 subscribers, and just trying to get people to think about average inflation as opposed to inflation targeting has been almost an impossible task. Like, I understand, like, the people who follow me on this channel have internalized it, but nobody, like, nobody else knows. I mean, maybe a few people that we've communicated it with. And unless you have internalized it for that reason, that I need this information so that I can make better decisions with investments or business or voting or whatever it is you got, you're studying this information for, you have to realize, and when you're looking at it, nobody else looks at it this way. Nobody. And so when I say, hey, we shouldn't be going into cryptocurrencies, we should be paying attention to the cashless societies that are going to be pushed out there and stuff like that, nobody's going to do anything about it. Like, literally nothing. Because if I can't get them to even understand about average inflation targeting as opposed to, average inflation rate over time as opposed to a target, like, if I can't communicate just that simple little difference out there to the people, there's sure as hell no way that I'm going to get them to not use, like, to stay away from a cashless society or stay away from digital or something like that, or to try and do more bartering with silver and gold. Like, it ain't happening. It ain't gonna happen. Like, I don't even like to waste time and effort and energy in that direction to try and make that happen. I think it would be hopeless and futile. So, I don't even attempt to do it. I try to share the information that I have acquired and found out there, and presented in a way that I feel is going to be useful to the people out there. Like, even if you were just a working class average dude who's just trying to figure out how to save, or maybe do little tiny investments, or maybe even just try to start up a business or something of that nature, internalizing this information gives you a much better advantage over most of the people out there who are falling for this mainstream media narrative. It's just like, you will just intuitively be making good decisions based on the information that we have now internalized about the Federal Reserve. Most people, like I said, when I look at the articles that I read out there, it's all wrong. Every bit of it. Like, not a single person out there has got the Fed's monetary policy dialed in any kind of appropriate fashion. Like, I can't find anybody. Literally nobody. And it's sad, because there's people who even work at the Federal Reserve, and I get it through all my comments and all that. Oh, you should listen to this person or that person. They really know what they're talking about. And I go and I listen to them, and they say something like a 2% target or whatever. And I'm like, no, they don't got it right either. None of these people do. Like, literally none. And I don't want to be like arrogant sounding when I say it, because I'm not trying to be that way. I was hoping that I would find information that was similar to that of what I'm seeing and feeling and understanding out there, and I can't find it. I can't find anybody else talking about it. So it just comes down to it. It's just like, okay, I got it right and everybody else has got it wrong. And I don't like feeling that way, because I know I ain't got stuff. Like, All Nighter and I were talking about this. We know we don't have it all right. You can't, like, nobody could possibly have it all right. It's just like, that's not capable. But when you're out there looking for the information that is similar to that of what it is that you are thinking and feeling and acquiring, but you can't find anybody else out there discussing it, it's just like, okay, so I'm on my own, and that's all there is to it. Is like, and it's not me, like, saying, hey, I'm brainwashed by some, messed up communications coming from the Federal Reserve. I mean, this is like all documents that are communicated to the other central bankers out there. And the way that they communicate it is not something that is easily understood. Like, it's spoken almost as if it's another language in code. So, like, sort of. In fact, it is. It's done in code. And so when you read through it and you finally, like, recognize the language, and you understand a lot of the lingo that is being said out there, it really starts to make sense. And once you start breaking it down and you understand how they had screwed themselves out of being able to adjust monetary policy through interest rate adjustments, And once you see that and you're like, whoa, if you don't have that, what are you going to use? And then they come up with this huge, elaborate communication style over the last 10, 15 years. And then you see it working as well as it is. It's like, wow, man, this is like, you guys planned this stuff out well in advance. And nobody knows it. It's so strange. I mean, I shouldn't say nobody knows it. I mean, you guys know it. You guys hear me talking about it. But when you go out there and you read the articles and stuff, nobody incorporates this idea or these strategies that literally come directly from the Fed. Alrighty, guys. I'm going to cruise down here. What time is it? All right, I got like 5 minutes left and I got to go. All right, it felt really good to finally sleep in my own bed last night. I bet it did. All right. Their confusion is on purpose, unfortunately. You're right. It absolutely is. Especially the stuff that you get on through the mainstream media. Like, the communications in general are very difficult, but then the mainstream media stuff is just completely, like, it's very inaccurate. I mean, like, very inaccurate. All right. Let's see here. Money in the bank and a little in your wallet is as safe as it gets. Thieves come and go, but their time is running out. Yeah, I kind of agree, you know. No codes, just economic speak. Yeah, but it's not really. Like, let me see. Do I have here? Let me just read from some of the Federal Reserve stuff here. Like, you know, even the speech, monetary policy strategies for a low neutral interest rate world. I mean, you just listen to some of the things that they talk about, and it is difficult. I'll just pick a spot and I'll just start reading. Let's see here. This topic is not only of academic interest. Let me see here. I can hardly read. Okay. As was recently announced, the Federal Reserve embarked on a review of its long-run monetary policy framework. I will argue that the global decline in the neutral interest rate over the past quarter century poses significant challenges to maintaining well-anchored inflation expectations in the standard inflation targeting regime. Right? So, already people are like, what the hell? And right, you start hearing this stuff. It was just like he's talking about inflation expectation and a standard inflation targeting regime. What does that mean? What does the standard inflation targeting regime mean? I will then lay out the alternative policy strategies that have potentially for providing a solid anchor for inflation expectations, even with very low neutral interest rate. Expectations versus the neutral interest rate. Now that seems kind of confusing. What does that mean? All right. So this is, again, like if you're not already understanding of the inflation expectations versus inflation versus the neutral interest rate and how these things end up correlating to each other, this communication becomes very difficult to retain. Right? Understanding it ahead of time, it's clear. It's clear. It's clearly spoken. Right? But most people don't get that clear with it. They hear it and it's just very garbled and it's jumbled and they're trying to understand, well, what does that regime mean? Is that different from what we are experiencing today? I mean, this is something that was given 2018 and they talk about monetary policy being different. And so what does this inflation regime mean? Yeah. Again, like not understanding this ahead of time, the rest of the speech gets very confusing to try and retain. All right, guys, I got to go. It was fun hanging out with you. All-nighter, it was great to see you, bud. I'm glad to see you back in the live stream again. You guys are always so awesome for hitting that like button. We have 142 people watching right now with 98 likes. Thank you so much for joining in on today's live stream and hitting that like button, supporting the Uneducated Economist. This is how we do it. All right, Uneducated Economist, you guys let me know.